Hello. Market drop yesterday, 28th of October 2020. Very unexpected and sharply. The Dow dropped more than 900 points, above 3% if you like, while Nasdaq relinquishes 3.7% of its gain. And again today, on the 29th of October 2020, the trend continues. The question many are asking is, what is really going on? Welcome to my channel. In this episode, I will examine the different factors that could possibly lead to the crashes and then analyze other investors' point of view. Let me start in Europe, since I reside here. French President Macron announced another lockdown recently due to the second waves of the virus, and then sent a warning message to all European Union members about the impending danger of the second wave, which could be deadly. Shortly afterwards, countries like Germany and Italy have decided to put measures in place, a possible lockdown as well. Okay, I have a feeling you want to ask me where all this is going. Well, stay with me. You see, as the second waves loom large, the government of each country will shut down businesses. In effect, it will affect the GDP. And you and I know, the higher the GDP, positive GDP boosts the economy. And GDP has a direct correlation with the performance of stocks. What am I trying to say? When businesses sector report an increase in earnings and production, the economy will reflect a positive movement in the GDP. However, as the government shut down businesses, the yield of goods and services will be low, inadvertently or inevitably, if you like. Stock prices will slide into negative territory. In my opinion, the above scenario is one likely possibility where we experience a sudden market crash. Why? Because the market would have priced in the emotion and sentiment. And to know more about how GDP is related to stock, check my video titled GDP and Stock How. You will see it at the end of this clip. Okay, back to the topic of the day. Again, in the US, states like Chicago has ordered a shutdown of all indoor dining because of the recent surge of the virus. That said, some investors argue that the second wave of this virus should not be seen as a threat to the stocks. And I quote, "Investors hope that the pandemic will not force further stringent mitigations measures or potential wholesale lockdown that will push global economy back into low consumption mode," said Yusuf Abbasi, Global Market Strategy at StoneX, end quote. And in another development, some strategists, school of thought if you like, have stated that the market is being manipulated, which in effect lead to an overpriced asset. Consequently, crashes inevitable. They also noted that this act of manipulation is distorting the situation of, quote, the unbelievable inflated market, end quote. What does it mean? Well, in my opinion, it means the market is already overpriced as it is now. Then the ongoing cash injection from the Federal Reserve continues to fuel and inflate the market, as we have seen in the first and second quarter of the year 2020. And again, during the production of this video, another stimulus package is in the making. Again, I know you like to know the consequences of this action. Well, the bubble burst will become inevitable, as we have witnessed 2 days ago. Well, I like to state this. Before the sudden crash, some investors believe that the stock market has factored in the upcoming presidential election, and as such, the rising stock price in the month leading to the presidential election almost always predict that the incumbent will be re-elected, but not this time around. According to reports, polls are pointing to Biden victory, while the S&P 500 index has gained 4.5% since August. Well, if Biden does win, and if Democrats sweep Congress, as polls also indicate, it could be a good sign for cyclical parts of the market, said Jeffrey Schloss, investment strategy with ClearBridge. That said, in my opinion, finger crossed. Okay, here comes the best part. Subscribe, like, and comment. The goal is to generate wealth, build companies, and create jobs. Bye now. See you soon.